Hello, everyone. Joe Mass here. Hey, we're shooting another video today. I see the markets are letting us develop this theme of keep calm, carry on. So I know we've shot some videos over the last few weeks. Believe me, my intent is not to shoot a video every week because, again, we think you should keep calm and carry on. But we did want to give you an update because yesterday, Sunday, was a crazy day. We had a perfect storm. We had we had the futures markets tanking, and they were curbed in overnight trading due to the oil war between Russia and Saudi Arabia, who's probably going to really negatively affect our oil companies here. So for the oil companies that have weaker balance sheets, that's not going to be good for them. So we had that. We had North Korea testing some more missiles towards Japan. We had the 10-year down at, I think at the lowest was about 35 bips, 35 to 50 basis points. So we had a lot going on. I was up basically all night looking at the futures markets and just wondering how bad it was going to be. So we came out pretty good. And again, because most of you have a plan, that's really saving you. ABC plan, bucket plans, financial plans, the retirement planning process you go through really is saving people, and it's giving you the right allocation prior to the event happening. And that's really what we need. We need the parachute before we get on the plane, not after we get on the plane. Can we go back and ask for our parachute? So today, our asset allocation strategies, we have several, but on average, they were only down between 42 and 56% of the market. The S&P 500 was down about 7.57% today. And so our asset allocation portfolios were down, just about half of that. So we felt very good about that. Being down about half of what the market is, we'll take that. Our stock portfolio, the more aggressive growth was 68% of the market. And when you combine the use of our focused dividend and our focused growth portfolio, you were only down 89% of the market. So again, a little higher, but those are your equity markets. Those are the portfolios that you're supposed to be taking risk on in hopes of getting return. So they are going to track closer to the market. So again, across the portfolios, we held up very well in this market, and we just want to let you know. To put it in perspective for you, in 2018, the fourth quarter, the market had a drawdown 65 days to the bottom from peak to trough, and the market was down 19.7%. It took 81 days for the market to recover. In 2007 to 2008, the Great Recession, the market went down for 355 days for about almost down 57% from peak to trough, and then took another 1,021 days to recover. And back in 2008, most clients working with an advisor, they were only down on average about 14% compared to the market being down, 40%. So again, working with advisors and having a plan ahead of time really pays off in these turbulent times. So we're happy about that. And then in 2020. It's taken us 13 days to go down 18.5%. And of course, we don't know how far or how long that's going to continue. Again, like we said last week, we believe it'll probably get a little bit worse before it gets better. And so we'll keep you posted on that. So as we've always talked about, there's three things that drive these markets: interest rates, inflation, corporate earnings, and the Fed. So the Fed is still being very accommodative. The earnings are definitely going to be affected by the storm of the COVID-19 storm now, and the whirlwind with oil in North Korea and everything we just faced today. So we are expecting some earnings to slow down. The probability of a recession is much higher now than it was. Some people have it as high as 50%. And a thing to remember there is that we got into this in a V-shaped manner, right? 13 days, we're down 18.8%. Now, year to date, it's not quite that bad, right? But it was a V-shape. It came on quickly, as we discussed in our prior videos. And so it'd be very normal to expect a V-shaped type of recovery, that once the storm blows past, that because prior to this, in a fundamental position, or fundamentally speaking, we were in a pretty good position with interest rates, inflation, and earnings. And so that's not what caused this. It's the coronavirus and really the panic of that is setting the markets off, on top of the oil in North Korea and the other events that we've experienced over the weekend. So we would expect that to be a good recovery, a sharper recovery, as opposed to a longer drawn out recovery. But we'll keep you posted as data comes on as we get through this storm. The other thing that we would talk about on the recession front is that at the beginning of the year, we had the consensus estimate of GDP growth at around 1.8%. And, with a little slowdown from this current economic crisis, you can see it'd be very easy to lose that 1.8% GDP growth. So again, that's why the probability of a recession is higher. And the positive is that because the fundamentals were pretty good coming into this, hopefully it'll be a short recession if it comes with a V-shaped recovery, and it won't last as long as other recessions. So a couple of things I'll point out. There's always two sides to the coin. We had a great jobs report, so that's encouraging. The challenge is to make sure that the consumer still has confidence enough to spend. Right, 70% of GDP comes from consumer consumption, and so the jobs are good. People are employed, lowest employment ever. That's awesome, and we just hope that people will continue to feed the economy, not in an unprudent manner, but in a normal fashion in a balance between savings and consumption. The oil crash, again, 30% down overnight here. And that's going to hurt like I said earlier, it's going to hurt the U.S. companies. But in the long term, it might give you a little boost, right? The clients out there are excited when they pay less in taxes at the gas pump and less at the pump. And so you could see some relief there. Hopefully that if that tailwind comes in from the lower oil cost, hopefully that'll partially offset, or hopefully fully offset, the COVID-19 economic slowdown. So we got some two sides of the coin there, and some counterbalance to that data. The other thing that we have is Treasury rates are extremely low. So those of you who haven't refinanced yet, or have and are looking at refinancing again, that could be another little boost to the economy. So again, everything has two stories. There's two sides to a story. In this case, heads and tails, bulls and bears, pluses and minuses. So there's some conflicting things going on. And so we are continuing to manage through this for you. Again, we are not panicked yet. And if we do, we'll let you know. But you have a plan. You're in good hands. You're following the financial planning. The portfolios are lopping off a lot of the risk in the market. Yes, they're down, but they're holding up, and they're doing what they're supposed to in these times of turbulence. So as I started off with, keep calm, carry on. And stay tuned. We will update you and communicate the best we can. For those of you that would like to put some more money to work, just let us know. A lot of people, this is a good buying opportunity. Like we've been saying, half the people want to buy, half the people want to sell. So if you feel it's a good time to put more money to work in the market, let us know, and we'll get that to work for you. So again, thank you for letting us serve you. Have a great week, and keep calm and carry on. Thank you.